Hello, I'm Robert, and welcome to my channel, where I discuss everything automated algorithmic trading, or simply algo trading. Today is going to be a fun day where I'm going to talk about some of what I spoke in the last video between full candle and wick with a side-by-side comparison between the two methodologies. But first, I want to talk about a new feature in TradingView. Setting an alert on an entire watch list. Instead of having to go through and set alerts one by one, you can create a watch list of a whole bunch of different instruments or assets and then set an alert on that entire watch list. It is incredibly easy to do, and quite frankly, if you're going to do it for one particular strategy like what I'm using, it really is the best way to do it. I have 60 different instruments I want to set alerts on. Now I can either use the watch list and set 2 alerts, one for buy, one for close, or I can go individually and basically end up setting 120 alerts. The watch list just makes this so much easier. All you do is click on the alert. That would be that button right there. It's going to bring up the alert pop-up. Now you can either stay with the symbol or click on it and you'll see the watch list, the alert that I wanted to use. And it is filled with 52. Now, if you have more than one, they'll show up as well. But if you do a watch list alert and it changes, and now you can go through and do everything you would normally do in your alert. Your strategy, the whole 9 yards. Set it up. Everything like you would from this point forward, but instead of just one single instrument, you are going to have a signal on any instrument in this watch list. Now, if you're using Jackrabbit Relay, in order to keep your risks under control, you can set the max assets setting in your configuration. I have mine set to 3. So that means I have 3 different instruments at one time, no matter how many signals come in. So as one instrument sells off and opens up a free slot, then whatever the next one is will kick in. This is perfect for volatility sniping, because a more volatile pair is going to more likely trigger a signal first. So you're always guaranteed to have trades going in your system by using this approach. And that brings us to what I want to talk about today. Of course, once you've got your alerts the way you want, click on OK and they will be set, so that when you see them, you have your watch list, like the 2 I have right here. So 52 items, perfectly set up to go completely the way I want it. Perfectly done. This is a real time saver when you want to use one strategy on a wide range of assets. But now looking at the charts, now that I have my asset set up for the strategy that I want, using my compound channels, volume, DCA, the same basic strategy I've been demonstrating over the last couple of videos. but there is a difference. The left side of the chart is set for trading above the full candle for take profit. So wherever your take profit line is, the candle completely must be above it or below it if you're shorting. The right side is just the wick. So if the candle wick crosses the take profit, then the sell takes place. Now I wanted to do a side-by-side comparison just so you could see one from the other in terms of exactly how that translates in profitability. It's rather interesting, really. So we're going to mark this as full candle and this side as wick. And then we're going to go through and actually watch the numbers to see how much of a difference there really is. For example, looking at the particular pair we're on, Australian dollar, Canadian dollar. We can see 3 trade cycles each. For the full candle, it's 25-20%, basically 25 pips. The wick is 22 pips. So you can see the difference of 3 pips profit lost by simply going with wick over full candle. And of course, the last profit of the full candle is 33 pips versus 25 pips for just the wick. So you see again just how different that profitability is. The thing to remember about this whole process is it isn't really about whether or not you're going to have a significant amount of trading. For the most part, it's about risk. How you want to handle your risk. That is the entire bottom line of this discussion. Now let's move on to a few more pairs and see how that works. Again, the left side will always be the full candle. The right side will always be the wick. And we see again, looking at the left side, 8 trades per cycle with an average of 23 pips. The right side, 8 trades per cycle with an average of 19 pips. So you can clearly see there is a difference in profitability. But is that difference enough to justify the additional risks of a full candle versus a wick? Let's keep going. Now here we see the real first major difference between the two methodologies. The full candle has 7 completed trade cycles, but the wick has 10 completed trade cycles. The average profit of the full candle is 26 pips, but the average profit of the wick is 18 pips. The last profit of the full candle was 32 pips, but the last profit of the wick was 19 pips. It can be quite dramatic depending upon the pair. Does it warrant the additional risk? That is the part that you have to factor into your own personal trading. Now this is a good example because it doesn't happen very often of just how different full candle versus wick really is in terms of the dynamics that occur within your market saturation, price movement, and other factors within the scope of the trading process itself. So let's move on to the next one. Okay, we can see here Not too much on this one all the way around. We see a little bit of difference on this one in terms of the trade cycles, but the average profit shows a difference of 8 pips. So again, we are seeing that separation can take place in relation to just how the profitability is affected between the two methodologies. As we keep going, you'll often see as well that the differences really might not be that drastic on some pairs, meaning they're close enough that it might be a toss-up in terms of which way to use. But since this is a watch list, I want consistency throughout the entirety of the watch list. Again, we don't see too many differences, but there are enough that the average profit does show a clear consistency in this particular pair. Always remember, this is about risk. Always. And in this case, we see on this screen, 2 trades on the screen that took exact place through both full candle and wick to take profit measured exactly in the same location. A rarity, really. Usually they don't line up as frequently obvious as these two, but there is still enough of a difference between the average and last profits between both methodologies to carefully examine the stability of the process in relation to your own budget. Now, in my particular case, maximum number of 5 positions is all I'm going to allow. And this particular one shows a massive difference. Literally 8 trade cycles for the wick versus 4 trade cycles for the full candle. And we can clearly see a very distinctive difference. Let me hide the words. Maximum buys per cycle are 3. And on the wick, maximum buys per cycle is 1. So again, we have a case where there is a distinctive difference between the two sides. Something that doesn't happen often. But it is certainly enough to really make it stand out. So as we continue, let's see what other interesting pairs we have to see. Here we can clearly see the actual trade really doesn't have any difference between the two situations. But again, the last profit and average profit do have some distinctiveness. The wick will always be slightly lower than the full candle, even if the trade cycles are identical. And that is something to always be aware of. There will always be a difference. Sometimes not very much, sometimes quite drastic. So as we continue looking through each one, we can clearly see, sometimes surprisingly, for example, the wick on this one has a last profit of 11 pips. However, the full candle has a last profit of 22 pips. That is literally double the profit. Now, is that something that is common? It could be for this pair, but it certainly is something to be able to take into account when you're deciding which way is better for your risks. The average is 18 pips for the wick versus 22 pips for the full candle. So again, you have a condition where the framework can be somewhat dramatic, even though in this case it's only one purchase per cycle and the trade numbers are the same. In this particular situation, this pair had a drastic difference between the full candle and the wick. That particular pair, Euro-Canadian, is usually an interesting pair to trade to begin with, and it is quite profitable. So having that difference might be a situation to pay real attention to as a governing point throughout the entire process when you analyze what pairs you want to trade. Always look for the outliers because they can help you gauge just how different the market can be between two different paradigms. For example, in this particular pair, Euro-Franc, we can see that the max buys per cycle are different and the trade cycles are different. Now, ironically, here, there isn't as much difference between the average profit and the last profit, not compared to what we have seen. So you have cases where the wick could actually be better than a full candle based upon market conditions. Euro pound, and we see not really much of a difference except the last profit shows a significant difference, reasonably speaking. I don't know that I consider 1 or 2 pips to be really a significant difference when it comes to the average profit, but the last profit showing a 2 pip, that might be significant depending upon how frequent that occurs. Okay, again, we are seeing a difference between average and last profits between both sides, even though the max buys per cycle and the trade cycles are the same. So this is quite an interesting way of looking at the market. And we can see the wick has one more trade on the Euro JPY versus a full candle methodology. Is that a significant issue? That could be, considering last profit on the full candle is 27 pips, whereas last profit on the wick is only 16 pips. That's quite a drastic difference in profit. But again, the difference in profit also translates to a difference in risk. Always understand your risk, particularly if you're going to use a watch list style approach for your alerts, because this isn't just one pair. This is 50 plus pairs all using this same approach. Even though I have limited my trading strictly to 2 pairs using this, because I have my grid bot always sitting on the 3rd pair. The realization is that this still has risk when you aggregate it across a large number of pairs. Which is really for the context of why I am doing this. I chose Wick just because Wick will get me out of the pair quicker on most cases than full candle, meaning I have slightly lower risk. But because I am aggregating this across 50 different instruments, I am also aggregating my profits equally, with my limits being no more than 10% of my account, with 1% positions. So I have taken an approach that allows me to limit my risk, even though I am willing to give up a little bit of profit. But that is my risk assessment for the way I want to trade. That really is the key point that I have to emphasize. You have to think about your own risk assessment and how it is going to affect your trading. Because as we can see from most of these combinations, full candle versus wick doesn't always give a huge amount of difference. Sometimes the differences really aren't significant enough to really go through the process of talking about. Sometimes, as we've seen already, they can be quite dramatic, anywhere from 7 to 10 pips. So it's a situation to really stay focused on in relation to how you trade. Here is another example where the average shows a significant difference. We have 16 and 10 pips respectively between full candle and average profit. Last profit 22, which is equal on both. So this shows just how different the process for the exiting is. On the full candle, the exit is going to have slightly higher profits, even though it's going to take a loss trade because it hit the maximum 5 allowable positions. Whereas on the wick, because I have less profits because I am wick trading, meaning when the wick is crossing my take profit, I'm also seeing that in my average if I take losses. The losses are going to have a more profound impact on my average at wick trading than they will at full candle trading. If this was being traded by itself, that pair, then I would have probably gone strictly full candle only. But because of the aggregated approach of what I'm using, wick trading is a better realization for what I am using. Now here we have 9 trade cycles for the wick, 7 trade cycles for the full candle for the European ZAR. Now again, looking at the differences of the average profit. Full candle is 25 pips, but average profit is 10 pips on the wick. Significant difference, 10 pip difference between the two. But when we look at the last profit between the two, this is rather unusual. Usually, full candle always has a higher last profit. Always. But that is kind of a strange anomaly, and that always isn't always. Because in this case, with the European ZAR, the last profit of the full candle is only 24 pips. Well, almost 25. But the last profit of the wick is 26 pips. So the differences get turned completely upside down in some very interesting case studies. So now we get into the British pound, in this case Australian dollar. And yes, this translates equally to losses. The full candle has a total loss of 10 pips for the average. The wick has 12 pip loss for the average. So averages are also affected in a losing trade. Losing trades do happen when you have this type of a constrained situation. 5 trades maximum. So in this case, it hit the 5 trades, it took the loss. The full candle takes less of a loss over time than the wick-based trading strategy. But because I am trading 52 different assets in one single watch list, the likelihood of a single loss having a significant impact isn't going to be as drastic compared to the overwhelming amount of profitability that other trades are going to occur. Now that is, of course, stated with a cautious optimism because nobody knows the market. And if I get a high volatility run that just goes completely against me multiple trades in a row, it's not going to matter. I'm still going to feel the bite of the losses. And that really is the entirety of the point of what I'm trying to express with being able to look at your risk in a methodical, consistent, planned out approach. So we can clearly see just how interesting this process really is as we continue to go through all of these different pairs. I'm probably going to complete just the British pound section, but really I think we can see already the stark differences between the full candle trading approach and the wick trading approach. I can't say one is better than the other because in all honesty, there's really no difference between one and the other except the level of risk you are willing to accept. That is the bottom line, really. The approach you choose is strictly on the basis of your own risk. So we have a significant level of trading that can be done with the brand new watchlist feature. This is really wonderful because from personal experience I can tell you setting up 100 different instruments was a nightmare. Having a watch list where I can load everything up in one strategy is a blessing beyond all reason. This really is a drastic improvement to TradingView. And being able to take and limit through Jackrabbit Relay the amount of spread I'm willing to accept is another situation. For example, 47 pips. I have my relay set so that I only accept trades when the market is below 3 pips. So by using this kind of approach, I could have 1,000 instruments and only deal with the instruments that meet my spread. That's critical. That's important. And that really is the best way of managing the entire process. So I never have to worry about getting into something that's going to cost me more because of spread than I want to pay. So my limit is 3 pips. If it's not 3 pips, I don't buy it. I'm guaranteed to stay out of markets that don't go in my favor. This one is 1.7 pips. So if a signal comes up, I will get into it and I will be quite happy. So let me know what you think. Which method do you prefer? The full candle approach, as we saw from the left-hand side of the screen, or the wick approach, as we see from the right-hand side of the screen? Share your thoughts and let me know. I think they each have their place, but if I'm doing a large amount of aggregate trading, I personally like the wick because it keeps me in the market for a less amount of time on a general consensus, which means I am more likely to benefit from market volatility. Full candle, though, has the advantage of really showing that profits can be better than expected, albeit you will stay in the market slightly longer. But nonetheless, I want to know what you think, how you trade. So let me know. If you found this video useful, please give it a thumbs up. Hit that like button. It really does help this channel grow immensely. If you're not subscribed and you want more videos like this one, please subscribe. Thank you for watching, and until next time.